if you feel the stock is going to move down to 1750, you do not want to buy the 1750 call, even though it gives you the right to buy the stock at 1750. Instead, a more attractive strategy is actually to put on a vertical spread at the 1750 level on the put side. In other words, you would go in here at the 1750 and you would sell a vertical spread. Now this does a couple different things for you. Number one, you can determine the number of shares that you actually want to buy. If you want the stock put to you, that's why they call them puts. If you want the stock put to you at 1750, in other words, you have to buy the stock. If you sell the 1750 put, you would have to buy the stock at 1750. So, number one, you get the stock at the price you want. You get the price of the stock set for you by the option that you sell. If you wanted the stock at $15, well then you would change this. You would change the one that you sold to the $15 level. Now you recognize the fact that when you're selling a vertical spread, you receive a credit for this. Just like we do iron condors, we're selling vertical spreads. We're selling a vertical spread on the call side, and we're selling a vertical spread on the put side. Well, in this case, the only thing that we're doing is selling a vertical spread on the put side because we want to set the level at which we purchase the stock. If we think the stock is going to drop to 1750 and we would be very, very happy to own that stock at 1750, then we sell a put. What happens when you sell a put? Well, it gives the put buyer the right, but not the obligation, to sell the stock at 1750. So by being a seller of that put option, they would, if they exercise their right, and they would do that if the stock dropped to 1750 or below, then you would be obligated to purchase the stock at $17.50. If we wanted to buy the stock at $15, we would sell a $15 put option in order to purchase that stock at $15. Now, we could just sell it. We could just sell that option, but what does that do? Well, just selling the option without a corresponding purchase of another option to protect that position gives us unlimited risk. Well, almost unlimited risk. Let's take a look at the analysis again here. What happens is it allows us, if we sold a put option, it gives us a little bit of premium here, but it also gives us almost unlimited downside risk. I say almost unlimited downside risk because the stock can't go below zero. But it does give us a tremendous amount of risk on the downside if the stock continued lower. So that's why we always protect the sale of a put or sale of a call with an additional call or put to protect our position. So let's say we wanted to purchase the stock at $17.50. We would go ahead and sell a vertical spread at that level. Let's say we wanted to purchase 500 shares at that level. We thought that was a very attractive price. Well, at this level, if we wanted to purchase 500 shares at $17.50, we can enter our order for a put spread to sell the $17.50 and then purchase the $15 puts as protection against that. And here's what happens when we analyze this particular trade. If the stock moves up, we make our maximum profit of $195 on 5 contracts. If in fact the stock drops, what will happen is if it drops below our $17.50 level that we want to purchase, well, guess what? We're going to get that stock at $17.50 if it drops below $17.50 at expiration. But at the same time, we're also going to be protected with the July 15 put. So we will be long 500 shares of Citigroup at $17.50, and then we will have our protective put in place at the $15 level. That does not give us, of course, 100% protection, but it does give us some protection if the stock should move even lower than that. But in the meantime, if the stock does not fall to 1750 and continues to move up against our position, well, we still make money. Like I said, we get paid for waiting. We get paid for waiting for the stock to drop to 1750. For the month of July and these July expiration, which is about, let's see here, we have 27 days left in July. We would get paid $195 for 27 days just to wait until the stock dropped to our price that we wanted. And it's as simple as that. And if for some reason, let's say somebody who purchased the 1750 puts wanted to exercise their options prior to the expiration date, well, we get to keep the premium. We sold those 1750s for 69 cents. We actually get to keep the premium from that sale, and we would also have the stock at the price that we wanted, if we wanted it at 1750. Now, the reason I say that this is really a strategy, an explosive strategy for people who have a little bit more capital to work with, is that you will have to, if this 1750 put is exercised, you will have to buy the stock at 1750. So if you sold 5 puts at the 1750 level, well, you're going to buy 500 shares at 1750. At 1750 times 500 shares, you're looking at an investment of about $8,750, which is not too bad. Actually, on margin, you'd only have to put up about $4,300. But you'd have the stock at 1750, which is a pretty attractive level. Now let's take a look at another stock. Let's go to BAC. Oh, wait, before I do that, I just want to point something else out to you. This is a particularly attractive strategy if you want to bottom fish stocks. Rather than purchasing the stock outright, and you wanted to really take a look at a stock that has fallen dramatically, for example, at Citibank. Citibank has fallen dramatically here, and you want to start bottom fishing to see if you can get it at a really good price way down in here. Well, the reason this is an attractive strategy for bottom fishing stocks is because of the volatility. I just want to take a look at the volatility here. The volatility on the July options is 79%. That's the implied volatility. That's relatively high because the stock has fallen so much. What does that mean for the options? Well, the options will be more expensive the higher the implied volatility. So as the volatility increases, it also increases the price of these options. It actually increases the value of both the calls and the puts, but we're only interested in the puts at this time. We can do some analysis here. Let's take, for example, let's go back to our Analyze tab here for a second. We have a vertical here that we can sell the 1750 puts and purchase the 15 put for a credit of 39 cents. What happens to this particular price, the price of this credit spread, if volatility were to decrease? You can see that the Vega, the Theta, the Gamma, and the Delta are about 80.73 on the Delta. So we're slightly along Delta. That means, in other words, that we make more money as the stock increases. Our Theta is $3.18. That's how much we expect to collect on a daily basis, getting closer to expiration. And our Vega is a minus 369. So in other words, if volatility were to decrease and we're short Vega, we would actually make more money.